I can't remember how many we're expecting, but we have about 25 or 26 people. So, all right. Well, we can go ahead and get started. So thank you everyone for joining us today for this webinar, Finding the Right Deposit Pricing Strategies. We're bringing you this webinar in partnership with Abrigo. And I'm Susan Seville. I'm the Director of Sales here at Federal Home Loan Bank. And I'd like to introduce our speaker today, Daryl Mateya. And Daryl, did I say your last name correctly?
Just right, yeah.
Okay, perfect. Daryl is a senior advisor at Abrigo, where he manages the Fair deposit and loan pricing services provided by Abrigo. He regularly consults with institutions on funding strategies, pricing analysis, and loan strategies. And he's a regular speaker at industry events for trade associations, Federal Home Loan Banks like us, and he teaches the Funding Track program at the Graduate School of Banking at Wisconsin. So thank you, Daryl, for joining us today, and I will turn it over to you.
All right. Thank you, Susan. And the first thing I'd like to do is thank the Home Loan Bank for inviting us and allowing me to share some of our ideas with you. I have to tell you, though, I wish we could be doing this at a resort or a nice restaurant, and I really look forward to the day when we get back to that. Because I'm getting a little bit stir crazy, sitting in my home office here day after day, but I'm not bored. In fact, I spend most of my time helping institutions pretty much on a daily basis with pricing issues, loan and deposit side, strategy, decisions, and so forth. This is the busiest summer we've ever had. It never slowed down. I remember the old days when old days when the stock market would take the summer off. Our markets would get calm. Not much would happen. People were on holiday. Well, this year, of course, is very different from that. And that's a good thing in many ways, because I know a lot of you are paying pretty close attention to adjusting to what you see going on around you rather than waiting until it's too late or you've spent too much or whatever. So that's the reality of our world right now. In a year like this, I think sometimes we overreact to what's going on. It feels kind of panicky in some ways, or we need to respond quickly when our environment changes quickly. But what I'm going to start with is a reminder that fundamentally risk management doesn't really change. When we talk about deposit or funding management, we always talk about it in terms of managing risk. That's what you do as an institution. Among the many other things you do, you're managing financial risk all the time. And the risk management process is, let's identify what those categories are so they don't surprise us. Let's ID the current issues that we've got going on right now. Let's deal with them. So I've got up on this slide the different categories we use when we talk about funding risk in general. And you can see what these are. I won't read through all these. Today, I'm going to focus on three of these that have kind of come to the forefront of issues we're dealing with in this environment. I'm going to talk about behavior risk in the form of these balances coming in. We're going to talk about costs, because costs can and should be changing, and we have this, of course, this margin compression going on right now. And then I'm going to talk about interest rate risk, because interest rate risk as a funding issue is always on our minds, especially when we anticipate that at some point we're going to be dealing with rising rates or somehow getting yield on our asset side, on our investment and our loan portfolios. By the way, I don't mind being interrupted with questions, and Jesse is going to monitor the Q&A section of the you have the Q&A window somewhere in your view of the event here, the WebEx event. So if you have a question at any time during the discussion, go ahead and type it in there, and she'll monitor that. I'll stop at a couple points and see if there are questions. And I certainly don't mind questions afterwards or via email on what I talked about, because I'm going to go through some of this stuff relatively quickly, given that we only have an hour to go through a lot of issues. Okay. Now, in addition to the general issue of managing risk, I also wanted to share with you what we're talking about, what I'm talking about on a daily basis, and me and a couple of my colleagues who do this daily. I just wanted to share with you, how these conversations are going right now. I'm sure a lot of this is going on within your institutions. The first one, the one that's kind of at the top of our mind right now, is this behavior issue I talked about. These surge balances, which I'll describe a little bit more detail in a minute. These deposits that are coming into our institution at high rates. For most of us, that's not true of everyone, but for most of us have this high deposit growth. What do we do with this? How do we manage it? That's issue number one. The other big issue we're talking about right now, of course, is margin compression and what it's doing to us. It's a significant asset liability issue. We make the majority of our income on interest margin, and of course, there's two basic sides of that equation. Our earnings on investments and loans and what it costs us to fund those, our cost of funding. And what side of that do we address? And do we manage to just the cost side, or do we also have to continue to pay attention to growth? Because let's not forget, we spent, most of you spent 2017 through 2019 addressing the fact that you didn't have enough funding, and you needed to be fairly aggressive and alert on that front. That issue hasn't gone away. Along those lines, we're still spending a lot of time talking about what I call premium pricing. And the question in this environment is there still a role for premium pricing, or should we reduce that, get our costs down as low as possible? I'll address that from a couple of standpoints today. And then one last thing I wanted to mention, we were talking about this earlier as we were waiting to get go live here. With markets changing every day, it actually becomes a little bit more important than it usually is to pay attention to what's going on in markets. In particular, when we talk about retail funding, your competitors and other market players like the national online people who have these online savings accounts and online CDs, they're changing rates on a much more frequent basis. So we have to pay close attention to that to make sure, for one reason, we're not pricing above the market. Again, I'll touch on a couple examples of that today. Excuse me. But first, the next thing we're going to do is we're going to have a poll question for you to respond to. Jesse's going to put up this question in a minute. What I want you to do, I want you to answer the question about what you think you or your institution's number one funding issue, I'm calling it a funding risk, is today. Is it A, liquidity, that we have all this stuff that flowed in, we don't know what to do with it. Our balance sheet inflated and our capital ratios went crazy. Is it liquidity from the other standpoint, which is we're worried that what this stuff that came in, we're going to lend it out and then it's going to go away. So we need to manage that. Is it costs? Is margin and margin compression your number one concern right now? Or is it interest rate risk? A lot of our clients are looking at booking longer term loans as one of the strategies for dealing with margin compression. So take a moment and vote. The poll question should have popped up in your window. Vote on which one of these you think is your number one concern today. No right or wrong answers here. I just want to get a general sense of what the group thinks. And I'm going to see if I can see let's see. I guess I have to vote as well. No, I'm going to vote for what I think the biggest issue is. So we'll give this another minute. Jesse, I don't happen to see the results. I'm looking here. So if you do, would you mind sharing those as soon as it appears everyone has weighed in? Or maybe you'll do that for me when they finish up. But I think we've given it enough time for now.
Yeah, I'll close the poll and you should be able to see the results.
Okay,
on the screen. It'll
pop up. All right, I just got ahead of myself. Thanks. Poll has ended. There we go. And now we should see our results. Is everyone going to see those, Jesse?
Yes.
All right. There we go. Our top vote getter, doesn't surprise me a lot, is that we have all this liquidity that showed up and we're not sure what to do with it. Okay. All right, thanks for participating in that. Let's talk about this surge activity. This chart you see on slide 5 is something that we can put together with our clients when we do core deposit studies for them. In other words, we have enough data to try to estimate what these surge balances are doing. A surge balance is defined as deposits that are flowing in or out of your institution at rates higher than our traditional. You know, we do these core deposit studies to try to figure out how long our deposits stay with us, what their average lives are, and so forth. And then things like a global pandemic happen and we get them at a higher rate. So this is one example where we went into one of our clients and studied their commercial, their business checking sector, and we concluded that as of the end of July, they probably had about 25% of the balances were surge balances. And in a couple of minutes, I'll talk about how the technique we use to try to detect that. So clearly, it's clear to see them come in. But they also had a lot of new balances because they brought on some new loan. They did a lot of PPP loans. That's going to bring balances in. Those balances are represented by the blue lines. That's not technically a surge balance in the sense that we want to track that differently. So that's what's going on, and I'm sure something similar to this is going on in your institutions. Now, one thing to keep in mind about surge is that it is volatile. It may or may not leave now, or before the end of this year, but it will probably leave at a higher rate. So we consider them shorter-term funding sources, even if we aren't sure exactly what's going to happen with them. And by the way, when they start to flow out, we're going to use some of these same techniques to try to figure out if and when that happens. Now, one of the reasons we're not sure exactly what's going to happen with these balances is because consumer behavior changes anytime there's a major economic event. This chart, which shows the personal savings rate, goes back to just before the Great Recession of 2008. And what's happened with our own personal and consumer balances, we're slowly and gradually saving more and more of them. If you can see out on the far right of this chart, you'll see a spike in that number because in the spring of this year, we took our stimulus checks and either paid down our credit card balances or stuck them in the bank, stuck them in a savings or checking account. So our personal savings rates have gone up. But we fully expect that, especially if this environment drags on and if it takes a while before we have a vaccine, for example, we think behavior may change. And that also means we're not really sure what's going to happen to these balances. That's why tracking these is such a big topic right now. How do we track them? This slide 7 here talks about a couple methods you can use. I'm sure some of you have already dove into this and tried to figure out what these surge balances are. A simple method to use, what a lot of you are using, is you're just tracking the overall balance growth and saying, well, we expected maybe a 5% growth rate in deposits in checking or in savings or money markets, and instead we have 10. That's one way to do it. The one problem with that method is there's a lot of seasonality in your numbers, and you also have new money coming into those for other good reasons. But that'll give you some estimate. The way we do it is represented by the chart I showed you earlier, and on the lower right, we call it the account behavior method. And we sort of perfected this method back during the last recession. It turns out that if you can track the growth of average balances in a sector, net of what we call outliers. Outliers are things like dormant balances that sit there and do nothing, or very large balances that can be more volatile, very large depositors. We kind of pull those out of the picture and we look at the growth of average balances. That turns out to be a very good predictor of surge balances if that increases at a rate faster than normal growth. Most balances in a like a checking account, for example, will grow over time if you hang on to that account at about the rate of growth in the economy. And when it exceeds that, we call those surge balances. Now, how are you going to figure out, if you've spent some time to figure out they're coming in, how are you going to figure out when they're going out? Well, you can get a hold of this data, try to do this kind of analysis. If you don't have that ability, one good indicator of when these balances may start leaving is if you pay attention to the number of dormant accounts that you have. Let's take a traditional savings account, savings sector. There's hundreds of balances that are sitting there below. We usually use a threshold of $50, and a lot of those accounts became active, and then they're going to go back to inactive when the stimulus money gets spent or whatever it is that's going to change in terms of behavior. So that's a detection method you can use to try to figure out when these are leaving, because again, we got to figure out what's going on with these as we plan, as we start to make our plans going forward, especially for a 2021 budget. So here's just a summary of what we are suggesting strategies use for surge balances. Number one is try to identify them. I'm sure you've already been trying to do that. So what do we do with budgets and planning? Well, there's a couple things going on. One is you actually have to budget your liquidity, right? You got to try to figure out at what rate are these going to continue to come in, or what rate might these start to leave. Now, we've got a big unknown going on right now that's going to affect this, and that is, are we going to have a second stimulus? Is Congress going to get together and figure this out? You know, it doesn't appear this is going to happen before this election coming up. We don't know. It's been so hard to predict anything going on this year. I personally think, in my discussions with institutions, that most people are planning and expecting that to happen, and expecting either a second surge of deposits or no decline in the surge that has occurred through the end of this year. But the bottom line is you got to plan on volatility. You've got to plan on potentially having to fund balances that may leave faster than you expect, because that's what a surge balance can do for you. And of course, you've got a great partner in the FHLB in being able to plug that hole should it be needed. So we're recommending people put their contingency liquidity plans together and make sure you're ready to go if this volatility is higher than you predicted. The second thing we're suggesting people do in their longer-term planning models or asset liability models, and we're doing this for our clients, is to increase the decay rates that we're putting in on longer-term balances, because when you have surge, your long-term decay rates go up. They don't go up by a whole lot, but they do go up. That will basically shorten the duration of your liabilities in an asset liability planning model, which we think is a prudent thing to do right now. The last point I want to make on this, the last bullet point, is don't necessarily change pricing strategy until you're a little bit more sure about what's going to happen with these balances. And by that I mean, don't assume that if this goes away, it's going to be easy to get it back at the same cost you think you're going to be at these lower costs. That may not be true, so it isn't a good idea yet to just assume you can go back into the market and get it. Now, let's talk about costs. I said I want to focus on behavior. We talked about that. Let's talk about costs. Here's a picture of the costs, the ongoing cost of funds for one of our institutions compared to the market. The blue line is the one-year FHLB advance. The red line is the 10-year Treasury. And the gold line, yellow line, is this institution's cost of funds. And our current cost of funds is higher than wholesale. That's not a very good thing, is it? That isn't something we want going on for a long time. That's a problem. So what do we do about this? And what do we set for a target? That's a discussion, as I mentioned before, we're having with a lot of institutions right now. Well, to answer that question, we really need to talk about how we deal with costs. On slide 10 here. Cost of funds is a problem when you look at it as a management tool, because it is simply a historical measure. We look backwards in time, we calculate an interest expense, an actual interest expense over some period of time, and we divide it by average balances to come up with a number. So we're looking through the rearview mirror, in that it's not telling us where we are going. The two measures we use for active cost management are the run rate and marginal cost. Now, the run rate is what you're currently paying to maintain your current balances. It's easy to calculate on non-maturity sectors because it's your current price sheet weighted by the average balances in each account that's priced differently. So when we take a current book of business picture in our databases, we simply calculate the weighted average rate of all money markets, the weighted average rate of all checking accounts. That's our run rate. That's what you're going to book today as interest expense on a daily basis to keep those balances. For CDs, it's a little different because we have to calculate that only on originations. It's not your portfolio rate, but it's the rate you're paying to originate new CDs. That's our run rate. But there's another cost that's a sneaky one that we always have to pay attention to, and that's the marginal cost of whatever is going on or whatever strategy you're executing. Now, marginal cost is a little bit more difficult to calculate because you need two different points. You need either two different strategies, I might do A or B, or you need 2 points in time. So we're going to look at a couple of examples of this. But what marginal cost tells you is the effective cost of a strategy you're thinking about doing, or of a strategy as it actually occurred relative to whether you grew or shrunk. To put it another way, it's the actual cost of raising the funding you raised when you're growing funding. Okay, so we have to look at those two categories when we decide how to manage costs. So let's look at a historical lesson here for some insight into this. A lesson from 2009. First of all, keep in mind we're in a falling rate environment, not a low rate environment. Look how long it took. The blue line here, by the way, is one of our clients' cost of funds as it ran out over that period of time. Look how long it took to get to where they bottomed out at around 44 basis points when rates finally bottomed. Also pay attention to the fact that the peer group that we measure them against, which is the orange line, ran consistently higher, okay? Costs are not inevitable in terms of where they end up. And the third thing I want to mention about this particular slide, this is a client we've worked with for a long time. While they were reducing their cost of funds, they were running specials, and they were still outperforming their peers. How in the world did they do that? Well, it's tricky, but it takes some work, and they managed to accomplish it. So there's a quick history lesson on why cost management still needs to be at the top of our minds right now, because we're not through this cycle or this environment yet. Now, what does the run rate tell us? Here's a picture of run rates from a different one of our institutions over the last year. If you look at the green line, that's wholesale rates. That's, again, that one-year FHLB rate. The red line is their run rate on their money market balances, and they've done a good job of bringing those down. That line is now down below the wholesale rate, below the one-year borrowing rate. And again, keep in mind, if I were to look at the cost of funds of consumer money markets, it would be higher than this number because it takes time for that average to keep falling down. Now, the purple and the yellow lines are the concerns here. This is the run rate on their current CD, long-term and short-term CD portfolios. And so this institution's done a really good job with the run rate on the money markets, but not on the CDs. And that's because they haven't yet turned off the CD specials. They've repriced them. They brought those rates down. You can see the rates coming down, but they haven't turned them off. And I'm going to speak about this again in a little bit in terms of what's going on there and what we have to consider in this environment. Now, one more thing I want to touch on cost here before we get into the last category, marginal cost. Here's a picture of cost of funds over the last 10 years broken down by size of institution. This is FDIC data. I always put this up to demonstrate, like I said earlier, that funding costs are not an inevitable outcome of the environment you're in or the competition or the repricing that you have to do as market rates change. It can be very different within institutions. Take a look at that red line. That's institutions in the $10 billion to $250 billion range. They were a lower cost of funds provider than you were. Most of you are going to be the blue line or the green line. They were a lower cost of funds than you coming out of the Great Recession. We were all at about the same cost of funds when rates bottomed out, 2015. And then look what happened to them. Why did they pay more for their funding in this last rate environment? Well, let's talk about who they are. These are the super regional banks. Around me, that's BMO Harris, Northern Trust, KeyCorp. Trying to think around you, that would be Commerce out of Kansas City, UMB. What are they doing? They're growing very, very rapidly. They have huge growth appetites, and so they paid up to grow those institutions, either through acquisition or through deposit pricing strategies. And there are significant differences in funding costs. The other thing I find fascinating is when I look at funding cost numbers between institutions and peers in different parts of this country, it can vary quite a bit. It's a very different picture up in the Pacific Northwest than it is up in Connecticut in terms of what institutions are paying for funding. So don't lose sight of the cost issue. It's not inevitable. Jesse, we're ready for poll question number 2. I want to ask you all to weigh in on where you think your funding costs are going to end up in your upcoming plan. And by that I mean whatever it is you're doing for budgeting or thinking forward to 2021, what do you think is going to happen with funding costs? We've flattened them out. We're good to go. We've got them down as low as we can in the basement, A. No, we're still working on bringing them down. We're not sure. Or there are a couple of people that are a little concerned their costs are about as low as they're going to go and they're going to have to go up. There are institutions who still have liquidity issues who may be facing that scenario. So please take a moment and weigh in on this question. We'll give it a couple seconds. While we're doing that, Jesse, were there any questions that came in on the Q&A over the first part of the session so far?
No questions, except a couple of people may not have been able to see the last poll. So if you are not able to see the poll, please put your answer in the chat box.
Oh, there we go. And then we'll assimilate them later then. All right, let's give this 15, 20 more seconds, and then we'll wrap up and see what you think about costs. I'm really curious about where this one's. I think I know what you're going to say, but I've been surprised a lot this summer.
Okay, we're closing the poll now.
All right. Thanks. And wait for it to redraw our results here.
All right.
There we go. Excellent. Yes, the majority of you people said we're actively working to reduce funding costs. That's good news. That means you're paying attention to it and you're aware that we're in this falling rate environment. All right. Thank you for weighing in on that. Let's move ahead. Let's talk about this other cost category that I mentioned. This is the sneaky one. We're going to take a closer look at this marginal cost thing. This particular slide demonstrates the basic concept. And what's going on here is this example says we have $80 million in retail deposit funding out there right now, booked at various rates that you see on the left with a weighted average of about 30 basis points. And we need to raise funding. And so we know, because supply and demand works pretty well based on price in deposit markets, we know we could probably raise some money. In this case, our target is $7.5 million with a promotional rate of 1.25. If you go to the market and go to the top of the market and make it publicly available, you're going to raise funding, right? The problem is some of your existing depositors are going to take you up on that offer. And so marginal cost takes into consideration the actual rate you're going to pay to bring in new money, plus the differential rate you're going to pay to raise what you're paying people who elect to take that special, whether it's a CD or a money market special. Some people are going to jump and vote. So the table on the right shows you what it actually costs you to raise $7.5 million, depending on what percent of people migrate over. We call it migration and cannibalization. If it's just 5%, you're going to pay 1.76 for that funding, not 1.25, because you're also paying the difference between, let's say, the 45 basis point average rate on the money market you were paying and the 1.25. And you can see as you go up that scale, that cost gets higher and higher and higher. Okay, that's the problem with marginal cost. It's a sneaky thing. Now, there's a lot of other moving parts and pieces to implementing strategies in marginal cost. So let me give you a couple examples of marginal cost in practice. Here's the marginal cost of a growth strategy, a very traditional one that we do over the years. The example here is like, my daughter's situation. She lives out west, and their cost of living is a little higher there, so they try to keep their emergency fund up pretty high. decent balances in there. I think she said their emergency fund is up to around $20,000. I was very proud of them. I said, so where'd you put it? She goes, well, we opened one of these online savings accounts because we knew we could get more yield. This was about a year ago. And I think it was around 1.5% they were getting online at the time. I said, you did check your bank, right, for that? She goes, oh, yeah, and no, they didn't have anything like that. So we have institutions that are trying to respond to that. They know they're losing balances to that mentality. My daughter's a perfect example of it. She's got a local banking relationship. They've got plenty of funding there. They've got their mortgage there and so forth. But they said, hey, we're going to compartmentalize this money, put it in a different place, earn some yield on it. So trying to respond to that with a local retail strategy means you got to think about coming out with a premium product that you're going to price higher to attract those balances. And of course, the issue is what if you get balances to migrate or cannibalize from your basic statement savings? So I'm not going to go through the entire machination of this model and how it works, but basically what it's doing is it's saying in the strategy 1 column, if you can see that, if we do nothing, we're probably going to grow this sector at 2%. But we think we can grow it higher because we know we're losing balances to market share. So with a promotional strategy, we think we can grow it at 10%. The problem is, and what we're modeling in strategy 2, if we do that, we think we're going to get some migration. So I plugged into our model some rates, some potential rates that we think they would have to pay. And in this case, we designed a product to have reverse tiers where you'll pay the most on the first $1,000. You'll pay a little less up to $5,000, and then a little bit less than that up to $25,000, kind of like a rewards checking account product design. What if we get 15% migration? Well, the marginal cost of this strategy, if it raises 10% funding, would be 93 basis points. Now, there's 2 issues there. One is, well, we have to measure that against our alternative cost. Our alternative cost of raising that funding in a wholesale market, we'd simply use the FHLB borrowing curve, right now would be 45 basis points based on a matched duration approach. So number 1, we have to decide whether we're willing to pay that or if it's better to raise that funding at cheaper cost. Number 2, we have to test this model with different assumptions because it might not be 15%, might be 10%. We actually almost never see migration numbers higher than 15% in well-designed promotional strategies where you've got effective barriers to entry into the premium product, but it could be higher than that. And then, of course, you have to play with the rates. Sometimes we change the rate structure to get a cost that we're happy with. So we use marginal cost in this scenario to make sure we're not paying more than wholesale costs to raise that funding. Now, we have another scenario going on right now that we're starting to model with our clients, which is what about sectors that are shrinking or that we expect to shrink? I mentioned earlier that example of our client who repriced their CD balances, but they're not really losing the balances and they're still paying more than wholesale rates. So here what we want to model is the marginal cost of negative growth. What if we turn things off? What if we walk away from these specials that, like I said, we've trained customers to rely on us always having out there? Well, what we think is going to happen, I'm worried about turning those off, Daryl, because we've got some good customers in there, and we think 50% of them will leave, go somewhere else. Say, okay, let's put that 50% assumption in, that 50% of them are going to leave, and the other 50% will see that they're renewed into your standard product and take a look at what am I going to pay on the standard product? Well, I've actually reduced that in my model from 50 to 25 basis points. If we do that, we reduce our expense by a significant amount, $217,000 annually, and we lose $14 million in balances. Now, we can replace those balances, like I said, at 45 basis points. If we want to continue that strategy, it's going to cost us 1.5% to continue that special pricing. Now, I'm very familiar with the argument that, well, that 1.5% isn't really accurate because it doesn't measure the longer-term cost of retaining that customer or retaining those balances. And I say to people, you just made an emotional argument with me. I would like the financial argument. I would like you to show me where you think that really costs you long term. We have to be sure we're dealing with emotion versus facts and what really happens. Just take a look at, if you don't like the benchmark number there, just take a look at what brokered CDs are going for right now. I know some of you are doing brokered CDs, you're not going to get 1.5% in a brokered CD market either. So your customer is also dealing with a falling rate environment. So this is how we use marginal cost for this scenario, and it's an important one that we have to analyze when we talk about how we adjust pricing with this special mentality that we developed over the past few years. Now, there's one more funding risk I want to discuss before we kind of wrap things up today. I mentioned interest rate risk earlier. Now, to illustrate where this fits in, this is a picture, a nice little infographic of how a loan pricing model typically works when we're trying to measure the profitability of loans. Competent loan pricing models take, a revenue base. Obviously, your loan income comes primarily from yield on interest rate, can come from fees as well. And then we have various expenses we want to book against that loan. We have the cost of funding the loan. We have our origination and servicing costs that we put into models. We have a credit risk allocation that we make because we're either going to make a specific reserve for that loan, or we're going to make an assumption about the relative loan loss rate that we have for a loan like that, depending on which risk category it's in. We've got another category called option risk, which is the risk that a loan like a mortgage loan with a prepayment option could prepay on us in a future rate environment. So we subtract those costs out and we get a return. It gives us some idea of how profitable loans are. We usually produce those returns as either an ROA or a return on equity. Now, where's interest rate risk in this picture? How in the world do we account for interest rate risk when we're pricing loans or dealing with the interest rate risk we know we have in lending? Well, let me give you a picture of where interest rate risk is. This is some rates from August of 2012 when rates had kind of bottomed out. In August of 2012, I could have made a 25-year fixed rate loan at about 3.75. That's got a duration of about 6.5 years. Duration here meaning the weighted average life of the principal cash flows, given that this is an amortizing loan. It's not 25 years, it's something shorter than that. So that's roughly how long that yield or that rate of 3.75 is fixed. Now, let's say for the sake of argument, we're going to fund that loan with CDs. We've got a healthy CD portfolio. We're paying about a little less than 50 basis points for those CDs in 2012. We got plenty of them. Okay, so that's the little gold triangle way on the far left of that graph. The problem is rates might go up, right? We have interest rate risk if we run into a rising rate environment, which we did run into. So that CD, if that's our funding source, is going to reprice about 6 times over the life of those cash flows and may increase his rate. Now, what's the blue line there, the connected dots? That's the FHLB funding curve as of August of 2012, what you would have paid to purchase advanced funding at each point on the curve. We could have fully hedged our interest rate risk by buying advance at about 2% in 2012, and we would have no interest rate risk. Okay, so that's interest rate risk in a picture. Now, you look at this and say, well, I don't really fund a lot of these loans with CDs, or CDs aren't a big part of the portfolio. What if my funding has a duration longer than 12 months? And it very likely does. In fact, we know, because we do lots and lots of core deposit studies, that the effective duration of most non-maturity funding categories is somewhere between 2 and 7 years. Now, that's a pretty wide range, and there's various reasons for that. We'll touch on those as we go through this discussion. But if I'm funding this with something like a money market, maybe I don't quite have as much interest rate risk in there. How do we deal with that? Well, let me jump ahead. Remember this picture for a second. Now, let's jump to 2019, August of 2019. There's the rate curve in August of 2019, perfectly flat, actually a little bit U-shaped. And I've got some different rates up here. I've got a 5.20 loan in the middle at a little above 3. I've got a 15-year fix, which would have been a little above 5% at that time. My CD went way up because all of a sudden I had to start competing for funds. So now my 13-month special is priced a little bit above the FHLB borrowing curve, and then my blue triangle in the lower area is my current run rate for money markets. So, the first thing to realize, let me jump back to the last slide for a second. Remember this curve and remember this curve. One of the lessons we learned in the last rising rate environment is that our asset liability models have modeling risk. A lot of institutions thought they were asset sensitive in 2012, but they weren't. At least in the environment that unfolded, they weren't. So we have these modeling risks that we have to deal with because there is obviously uncertainty in what's actually going to happen in rate environments. And there's uncertainty about our deposit durations. I said that money market accounts can have a duration. I've got this one pegged at about 30 months, 2.5 years. That can vary. That can vary within institutions. I mentioned earlier that surge balances are shorter-term funding sources. Our deposit durations have likely shortened in 2020 because we have these surge balances. So we have this uncertainty in managing interest rate risk. How do we deal with this? Well, let me give you a solution we use frequently in putting funding and business plans together. And I'm going to introduce this by drawing a picture of two options we have for funding a loan. Let's say we're going to fund a 15-year amortizing commercial real estate loan at 4.5%. That'd probably be lower today, but a while back I could have done one of these at 4.5%. Now, some of you are going to say, well, we wouldn't, are you crazy? We don't do 15-year fixed rate loans. There's too much interest rate risk in them. Okay. Too much. Well, let's define how much. So the bar on the left, the description on the left, I can protect myself. I can fund that with a fully amortizing advance, which in my example here, which is dated, would have cost me, I forgot what it would cost me, but my gross spread was 182 basis points. If I ran this through a loan pricing model, I'd have a decent return, a 10% ROE. I try to hit 15% ROE goal on loans that don't always get there. Or the right side of the chart, I could fund this with money markets that we're currently paying 60 basis points on. I have a bigger spread, gross spread of 420 basis points, plenty of margin. I've got a 33% ROE if I fund a loan that way, unless something happens to rates and our rate environment changes. So slide 22. What if rates go up by 300 basis points or something? Well, wholesale funding cost, the left bar didn't change, right? We've fully hedged the interest rate risk on that, and we've maintained, locked in our return. On the right side, a lot of different things could happen. The example I created here is I said, well, funding costs might go up 60 basis points or they might go up higher. Depends on what the beta is. It depends on how much more I paid to maintain those balances or grow those balances. Remember that red line I showed you on those the funding costs by institution size? What if I'm a rapidly growing institution, it's entirely possible my marginal cost of growing my money market funding was even higher than this. We've seen betas of close to 75%. We've seen institutions have to respond at 75 to 80% of market rate changes to maintain special balances and money market balances. CD betas often run close to 1, okay? So my margin on that loan went away. That's interest rate risk, right, in a nutshell. But the solution here is to blend these two approaches. Blended funding is managing interest rate risk by not relying on either one of these strategies to deal with all the issues that this problem creates. Blended funding dulls the negative effect of the drawbacks of a rising rate environment and still leaves you with some income advantage of the spreads you get by using your retail funding. Now, blended funding is exactly as it sounds. You design a funding strategy where you use some wholesale funding and rely on your retail funding and control your beta, avoid paying up to keep your retail funding costs and effective durations longer than they otherwise would be. Now, in the interest of time today, I have to save you several other slides of mathematical numbers and comparisons that show how we build these blended funding models and come up with these results. But basically what's going on is instead of getting this picture on the right is different returns on that loan in different scenarios depending on how we fund it. And we can fully fund it with advances and get a flat line, which means I'm locked into the same return no matter what. Or we can use a blended model, which is represented by the orange line, which says in various rate scenarios, I've protected quite a bit of my income, my loan ROE, and really have very little excess interest rate risk. And this is the modern approach we take to interest rate risk management when we're dealing with these problems. Okay, so I want to wrap things up by giving you a couple, 3 suggestions for what we actually do about rates. I haven't talked too much about rates here and pricing, but ultimately that's what you do, right? You have to set product and pricing rules. And remember, I said earlier that we don't necessarily want to change pricing strategy until we see what's happening with some of these surge balances. Let's take a look at what the volatility is. And what I meant was don't overpay don't assume that you're going to pay the same rate to get those balances back, which means you may end up overpaying for them. But there's some other things we can and should be doing in this environment right now. Restructuring product lines, we'll give you an example in a second. We need to assess market share opportunities in this environment. And I don't have time to go into that. We do have an article coming out where we discuss that. But market share is something that is always changing. There were a lot of market share changes that happened to markets as a result of the Great Recession, and there's opportunities as a result of that. Don't ever forget that consumer checking accounts always turn over at a rate of about 10 to 12% a year, no matter what else is going on because of demographic changes and population changes and so forth. You always have that amount of turnover in that sector, no matter what else is going on. That's a market share opportunity where there are some things, there are things you can always do to grow market share, and there are people that will be asleep at the switch because they have all this funding sitting in their balance sheets right now. And finally, don't forget about a role for premium pricing. I've been hinting at this for a while, and I'll tell you what I mean right now. So first thing to keep in mind, when rates are fully compressed, this is the time to think about bringing product lines together. What do I mean by that? Well, when deposit rates fall this much, they all start to look alike, right? And the effect is that depositors who decided a year or two ago to open these accounts, these premium type accounts, are now less likely to be concerned about the rate, especially when they see their monthly interest deposit is less than half of what it was last year. So what's happening is our product lines are going to start to collect non-rate sensitive balances, even if we think they are rates or premium products. And wholesale alternatives are cheaper right now than our premium products. And so it's a good time to consider getting rid of the specials we have. Now, that doesn't mean we don't continue to segment. It doesn't mean we don't offer specials. I mentioned that institution earlier in the historical outlook that was offering specials as they brought their rates down. There's all kinds of segmentation tools. A lot of you use a lot of these. And there's 3 I've highlighted here that I'd like you to keep in mind as you deal with growth, cost, and all these different trade-offs. One of them, of course, is new money. That's always a good one to consider, because new money doesn't just mean it's a new customer you're bringing into the institution. It means, bringing your balances if you're even an existing loan or deposit customer that may be in a different place. Limited time promotional rate. This is one of a favorite of mine, not because I'm emotionally attached to it, but because it works. Limited time promotions, every other industry uses this all day long. Act now, right? Just look around you at all the other promotional techniques that other consumer industry uses, getting you to act now and knowing that this is going to go away. The cable companies and the phone companies do this all the time, and some people are good at taking advantage of this and constantly reducing their costs, but most of us don't have time for that. And then the last one I want to mention is an interesting one. Do a rate promotion maybe on the other side of the balance sheet. This came from a discussion we had internally at Abrigo. We were helping someone determine if they could continue to afford to offer a 25 basis point discount on loans. I forget which loan product it was, if they also got the deposit relationship. And I don't remember if it was if you bring your direct deposit checking over or whatever. And we're having this discussion. I said, hey, wait a second. That 25 basis points is really expensive, especially now that rates keep dropping and dropping. What if we did this on the other side of the balance sheet? What impact would that 25 basis points say if we said, bring the loan in as part of that, as part of the promotion, you will get a 25 basis point bump on some special product on the deposit side, and that's another tool we have in our toolkit. This is a really good time to consider using something like that. So with that, those are my comments on what our situation is, what we're talking to people about, and hopefully some ideas you can take. I'm sure some of you are thinking about these and using some of these. As I mentioned before, don't hesitate to get in touch with me if you have other follow-up questions on what I brought up today. Thank you for your time. And with that, I'm going to turn it back over to Susan for a wrap-up now. Susan, you're still there, right? She's looking for the mute button.
Here.
There we
Sorry.
go.
It's just taking a second for the technology to kind of
find that mute button. Yeah.
There, I apologize. Yeah. So we really appreciate everyone's attendance today, and Daryl, we appreciate all the great information you gave us. Those are some really big things to think about. I hope everybody was able to gain something from today's session that they can use. And I know Daryl and his colleagues would be happy, I believe, to answer any questions you have if you didn't ask any during the session and would like to follow up. I'm sure they'd be happy to hear from you and help you. So with that, if there are no more questions, I think we'll just wrap it up for today. And always know you can reach out to us anytime, too. We'd be happy to help you with anything. Thank you again for everyone's attention today. Have a great day.
I wasn't looking. Did we get what was the total measure and number of attendees?
Daryl, I was looking at the chat. I think we were pushing somewhere towards 45, 47, somewhere in there. So,
okay, excellent.
Yeah, that's what it was.
Right.
Okay. All right.
Good stuff, Daryl. We appreciate it. And
if you thought of anything that I talked about, go ahead and drop me a note, or for tomorrow